All right, thank you very much. Microphone's good. I'm not booming the room here too much. All right, excellent. All right, well, thank you so much for coming on this rainy day. And so my topic that I'm going to be discussing today is personal investing. And so those of you in the room, there's, a wide range of ages. Some of you may be well down the path of your personal financial plan. Some of you may be just starting to think about it, and some of you may be in between. And so as I'm talking, feel free to raise your hand and ask a question. Feel free to interrupt me as I'm speaking to ask that question. If we can't get a microphone to you quickly enough, I'll hear your question and I'll repeat it into my microphone for the people listening and watching on the webcast. So my topic is going to be pretty much down the middle because financial planning is something that needs to be relatively tailored to each individual and their household and their needs. But most of what I'm going to talk about today is going to apply to pretty much everyone in this room. And the goal of my talk today is hopefully to bring down the level of stress that financial planning quite often brings to people. Is that obviously it's a very important topic. We're very worried about how we plan our money, how we save our money, and can we invest our money in the future to meet our goals, whether that be first home purchase or kids' college education, retirement, other needs such as that. And so it is something that causes people a lot of stress and trepidation. And so my goal here today is hopefully to simplify some of the language a little bit, to bring it down to a level where you can say, look, this isn't as hard as people make it out to be. And make no mistake, there is definitely an industry that has a vested interest in trying to make it as though you can't do this for yourself. And the truth is you can. With a relatively small amount of reading and research on your part, this is actually something that each one of you has well within your grasp. Okay? So a lot of what I'm going to be talking about today is actually going to come from two of these books. Not that these aren't in any other books or anything like that, but these two books that I've used in class, everywhere from courses I've taught in junior achievement at the high school level, all the way to courses that I taught at Cornell University, as well as Ohio State, and everywhere in between. These two books are written by a professor at Princeton named Burton Malkiel. And not that the name is terribly important, but the first book here came out about 15 years ago, this book called The Random Walk Guide to Investing. And that may be an odd-sounding title, but those of you that have maybe an interest in finance, a number of years ago, in fact, 40 years ago now, he wrote a book called The Random Walk Down Wall Street, or A Random Walk Down Wall Street. And so the premise of his book is to say markets are very unpredictable. And so people that look you in the eye and say, give your money to me because I know where the market's going, and if you trust your finances to me, I will lead you to this financial goal that you're achieving or trying to achieve. And what Burton Malkiel sort of debunked is this idea that markets are easy to predict and that there are professionals that can do it on a reliable basis. The problem is the data that we have really is strongly against that, is that the people that claim to be the experts don't really show themselves to be great experts overall. Now, you may hear that information and say, well, gosh, if these people who are claiming to be experts can't do it, well, then what hope is there for me? It's actually the opposite. We want to think about this, is that the world of investing is very much an even playing field, which means that when we're investing, we shouldn't have to worry too much about being fleeced by whoever some professional is sitting at their computer at Goldman Sachs or at JP Morgan or at some hedge fund somewhere. It's actually an even enough playing field where all of us has a fair chance of creating a portfolio in a relatively straightforward fashion that can meet our financial goals. And so that is kind of his premise here. And so these books, you can buy either one of these books. This one came out just a couple of years ago, kind of a freshening up of this original book here. But both of them are very good. They are very small. I mean, literally, I think, maybe 180 to 200 pages. I'm not exaggerating when I say that you could pick up one of these books after dinner and be done by the time Jimmy Fallon comes on. I mean, it's something that you could read in one evening. And all along the way, as you are reading through the chapters of this book, you would be saying to yourself, oh, I already knew that. Or that sounds logical to me, or that makes sense. And you'll get to the end of it and you'll say, well, is that really all there is? And it turns out, yeah, actually, is that, like I said, people try and make this a lot more difficult than it needs to be. And with a relatively small number of rules of thumb and a relatively small amount of logic, we can put together portfolios that meet all of our needs. Now, this third book here, this is more for those of you who are kind of early in your careers. So this doesn't necessarily apply directly to finance, but I thought this was a really good book about career planning. It's it's written by the guy who writes the Dilbert comic strip. And so it's a kind of an interesting book where he talks about his successes and failures in his career choices in life and his investing choices as well. And it's written with a lot of good humor. It's a pretty entertaining book. So, you know, if you're somebody, particularly if you're early in your career or middle part of your career and you're thinking, okay, you know, not only how do I want to plan my finances, but how do I want to plan my career, I think he actually has a lot of insights into how we might think about, you know, sort of developing our professional lives, whether that's looking at our financial plan or looking at our career plan. But primarily, I'm going to focus on these two books by Burton Malkiel. So in his first book, one of the first quotes he pulls is one that was attributed to Albert Einstein, is that everything should be made as simple as possible. Well, there's actually an addendum to that where the full sentence is, everything should be made as simple as possible, but not simpler. Right? So we should be able to boil things down to their essence so that everyone can understand them. Because once we do that, then what that means is that we're getting rid of all the clutter, all the confusing information that's unnecessary. And so the goal of this talk and the goal of this book is to try and do exactly that, is to say, let's sift out all the information that's unnecessary and focus on the stuff that we really need to know. And once we do that, it turns out it's a relatively small list of things that we need to know to be able to make smart investment decisions. So the rules for achieving financial security, they're easier than a lot of people think. And so the challenge is not knowing the financial world inside and out. You don't have to watch CNBC and Bloomberg TV and Fox Business Channel and read this magazine and that newspaper and this book and that book. It turns out a lot of that's unnecessary. In fact, it probably confuses the point and muddies the water far more than is needed. Now, if it's just a topic that you find highly interesting, well, certainly as a professor, I'm going to be the last person to tell you not to read more and not encourage you to learn more about a particular topic. But if our goal is to sort of optimize and say, okay, what do I need to know in order to make myself a portfolio that I can track over time that puts me in a good position to meet my financial goals, well, it turns out that that's a relatively small amount of information and straightforward amount of information. So I get asked all the time, what are the best financial publications to read, right? And there's a ton of them out there, right? There's Money Magazine, there's Smart Money Magazine, which is apparently smarter than just, regular old Money Magazine. Should I read the Wall Street Journal, the Financial Times, Barron's, Fortune, whatever it happens to be? It turns out, I would argue, a lot of times they're more distracting than informative, particularly if you're just starting out. Is that if you're just starting out and you want to know, okay, how do I get from point A to point B? Reading all of these different publications, it's going to be paralysis by analysis. It's just going to be too much information flooding the zone. And so I like this quote from Malcolm Forbes, which Malkiel uses in his book. So Malcolm Forbes, founder of Forbes magazine, what does he say? He says, the way to get rich from investment advice is to sell it, not to take it. Right? So the way to think about that is that if you look at all these magazines on the newsstand, and they all have these big blaring headlines, right, on their front cover saying, the 10 stocks you need to own for 2017, turbocharge your portfolio today. Well, if all that information was so accurate and so valuable, why would they sell it for $6 an issue, right? The fact that they're selling it cheap is probably a sign that it's not that great of information to begin with. It may sell magazines, right? It may draw people's eyes, but it doesn't necessarily mean that's going to lead you to the right portfolio. So, some of the basic points. Okay, first one, fire your investment advisor. Okay, now I put a maybe in there because there's actually a lot of very good reasons why we want to have a financial advisor. But my point in putting that up there is to say that every one of you in this room is capable of doing this on your own, right? You're intelligent, professional people. And so with a modicum amount of time invested and reading and learning that, you can put yourself in a frame of mind with a little bit of knowledge to say, okay, I can tackle this. This is not as hard as it's painted out to be. Now, the reason I put the maybe in there is that maybe in your career, you're just simply too busy to do this. If you're somebody who is a cardiothoracic surgeon and your hours are spent perfecting your craft, well, yeah, then maybe, having an advisor, handle your financial decisions, that may be a very good choice, right? That may be the proper use of your time. If your time is better used, perfecting your technique and learning the latest research, then yeah, I would say society would be quite happy to say, yeah, you should, instead of spending a couple of hours a month, learning about your portfolio, if those are hours spent honing your craft and perfecting your skill set, I don't think anybody would argue that that's probably a good choice. But like I said, with a modicum amount of time, we can all do this on our own. So it may still be the case where we say, yeah, it turns out our best choice is that, yeah, I don't have enough time or I don't have the inclination. Then in that case, certainly a financial planner can definitely add value and help sort of offload some of those decisions, help frame them for you. But for the rest of us that, have an interest in doing it, want to do it, and have a little bit of time in which to do so, this is something that's well within our reach. So if brokers and advisors really knew what was going on in the market, well, they'd be investing for themselves, right? So, brokers may be still calling you on the phone. That's something they still try and do. Harder to do in the cell phone age, but it still happens. But those of you who are professionals out there, your names get on mailing lists, and so you get approached either through mailers or perhaps even called on the phone. We have a great investment idea for you. Give us X amount of dollars, and we will turn it into Y amount of dollars. Pitches like that. Well, if these brokers really knew what they were doing, again, why would they be giving you this information for just the little bit of commission they get out of it? If they really knew what was going on in the market, what would they be doing? They'd be borrowing as much money as they could from the bank and investing themselves and reaping the benefits of that information. So again, not to denigrate financial planners, brokers, anything like that. I think a financial planner, particularly if they are sort of modest in their goals and focused on the right things, then they can definitely add value. But if somebody tries to look you in the eye and says, I know where the market's going next year or over the next 5 years, I think you should be very reluctant. I have a PhD in finance. I look at financial markets every day. I teach our students information about financial markets. But could I look you in the eye and say, I know where the economy's going, I know where the market's going? Actually, I can't. I wouldn't do that. And in fact, if you look at my own portfolio, it is structured very much as a passive portfolio. And if you're unfamiliar with that term, I'll get to it here within a couple of minutes. But what it basically says is that I structure my portfolio so that I don't have to guess what's going on in the markets. So next rule, focus on 4 investment types: cash, bonds, stocks, real estate. So you don't need to own derivatives. You don't need to invest in commodities. You don't need to do anything exotic out there. Those 4 basic asset classes are more than enough for you to structure a financial plan, 1, that you can understand, and 2, that can achieve your financial goals. So 3 factors determine your success. Not 27, not 18, but 3. And they're pretty prosaic. They're pretty basic. The first one, how much do you save each month? If you're not saving money, you're not building an investment plan. Simple as that. That's under your control, right? How much you spend of your monthly income and how much you are saving as the result of that spending, that's your first decision, and that's under your control. I mean, we all have fixed costs that, are hard to avoid, certainly, but the discipline that we have to restrain our spending so that we can increase our savings, that is something that's under our control. It's under our purview. Second thing, and that's mainly what we're talking about here today, how do we invest that money? How do we construct a portfolio so that it meets our level of risk tolerance, right? It meets the type of investments that we are comfortable owning, and that also is a diversified portfolio. And when I say diversified, the old adage of not putting all of your eggs in one basket, that's what we mean here. Basically, spreading our money out amongst different asset classes, stocks, bonds, real estate, not just in U.S. markets, but in international markets as well. All of those things are part of this second point. And again, this is under our control as well, is that if you can do a great job saving, but if that money's just sitting in your checking account, well, then you're not handling step 2 very well. The third step is once you've saved that money and once you've put together that portfolio, then it's subject to the returns of the market, and you don't have control over that. And if anybody says that they can exert control over that or they know where it's going so that you can have control over that, again, I would say be very skeptical of that person. I think that is an extraordinarily hard thing to do. But if you can control 1 and 2 well enough, you can just look for the average performance of the market, and that will be plenty. That will be enough. Again, if you plan early enough and discipline your spending so that you're saving enough, point number 3 is not going to make or break you. In fact, you can do just fine with just the average performance of the market. So that first step, yeah, this is primarily targeted to people who are kind of just starting out, right? Those of us who are of my age or around our age, I think we've kind of taken this to heart, but, or at least we know its value, is that, if you're just starting in your career, I think it's really valuable, though tedious, to pay attention for a few months on every single thing you spend and categorize it. Right? Find out, how much am I spending on coffee? How much am I spending going out? How much am I spending on clothing? How much am I spending on my fixed costs like, rent and insurance and car payments and things like that? And just lay it out for yourself after a couple of months and just get a sense of, okay, just how much money did I spend in this category or in that category? Now, the nice thing is that there's a lot of online free software tools that we can use to sort of track this stuff. Mint is one that I use. There's also MoneyStream, MoneyStrands, Personal Capital. There's probably a new one every single day that I'm not aware of. But they're basically ways which you can link your credit card, bank, and investment accounts, and it goes through your credit card statement and automatically sorts through the different categories of spending that you have. So at the end of a month, you can say, okay, this is how much I spent at the grocery store. This is how much I spent on restaurants. This is how much I spent in clothing stores. And so you can sort through that information and really get a sense. And sometimes it's very eye-opening. Sometimes you don't realize, just how many coffees you got over the course of a month at Starbucks. You say, wow, I spent, $55 this month at Starbucks. And, it starts to make you think, right? And not that it's necessarily the right or the wrong decision, but the more aware we are of what we're spending, well, then, yeah, maybe perhaps the more control we can exert over it, right? We maybe start thinking about, okay, do I really need this or do I not really need this? Once we start investing, well, there's a lot of very good online brokers out there, very, very low expenses. And this is also a key part of the talk, is that if you're handling your own finances, you're not paying a financial advisor to do so, then you can focus on minimizing the costs of what you're doing. And if you can do that, that keeps more money in your pocket. And it turns out there's more ways to do that than ever. You can put together a portfolio that has just a bare minimum of expenses vacuumed out of it each year, which leaves more of your money going to work at all times. So this is a screen pull that I took off of, not my account, but just a graphic that was online. This is a page from Mint. And so while this may be hard to read in the printout or even on the screen here, what it does, it tabulates, sort of your cash position. You link it to your bank account, your credit cards, any loans you might have, your investment accounts, the value of your home. So basically it pulls like Zillow's price estimate of your home or your condo or your apartment or whatever and puts that in there as the value of your property. And so at any moment you can log in and say, okay, what's my net worth, right? What's the value of my cash, my investments, my house, minus whatever loans or credit card balances I might have. And so it comes down to this final number, right? It says, okay, here are your assets, here are your debts. At this moment, given the information you've allowed Mint to access, this is what your net worth is. And so it's a very powerful tool that you can use to track the performance of your portfolio, how much you're spending month in and month out. And so it just gives you a lot of power without having to put forth a lot of effort. So to set up something like this will take you less than an hour, and pretty much all of that hour is spent just, you connecting it to each of your, credit card accounts, bank accounts, investment accounts. It's all very heavily encrypted. I'm perfectly trusting of it, So, take that for what it is. I'm not an internet security expert by any means, but I'm perfectly fine with it reaching in every month or every week and pulling data from my accounts and compiling it in Mint. Now, once we've kind of determined our level of savings and we actually start to put this to work, what's kind of our list of priorities? And again, some of you are going to be at different parts of this list than others, but let's say I started with somebody just graduating college, just took a job here at OSU at the medical center. And so the first thing I would say, well, we have to set up an emergency fund. And so as you're starting your career, cash is really tight. You have great future earning potential, what we call human capital in economics, but the current amount of capital that you've earned and created, financial capital, is you're starting, from zero or probably very, very close to that. So these first two things, I would say, are your first main two decisions. So what I tell people the moment they start a job, that first day on the job, fill out that 401k paperwork. it is so easy to put aside. Again, particularly if you're young, just starting on the job, right? You're getting your first job, you probably moved, to a new town, you got a new apartment, you've got all these startup things that you're thinking about, and that first day on the job, you're just meeting everybody, you're meeting your supervisor, and they pass along this sort of, pile of paperwork. Oh yeah, this is our 401k plan. It's just easy to say, you know what, I'll get to that later. Don't make that mistake. Particularly those of you who are, just on the job, or if you're, changing jobs or whatever, anytime this decision comes up, take care of it up front. Because you get that set at the beginning, set it up so that it takes a certain amount out of your paycheck at the beginning, and you adjust to that level of spending. One of the things we know in just sort of behavioral economics is that it's very hard to bring down your standard of living. The effort that it takes is much harder than it is for the benefits of increasing your standard of living. And by that I mean, if you sign up for that 401k at the beginning, then that money is taken out of your paycheck right from the start, and you sort of just get accustomed to living at that amount that is remaining. On the other hand, if you're on the job for 6 months and you hadn't filled out that paperwork, and then finally you think, oh yeah, I should fill out that 401k paperwork. Well, now it's like, well, gee, I was used to this level of take-home pay. Well, now it's going to be down, a few $100s. It makes it feel like a harder decision, even though it's the exact same decision. Start it from day one. I think it's definitely the better choice. So once we get past these two things, then when we're thinking about putting money in the 401k, what we want to do is we want to maximize something called the employer match. And I don't know what it is here. I'm not sure if you guys have a 401k or a 403b, how it's structured here at the hospital. But most employers, for every dollar you put in, they will match a certain amount, right, up to a certain level. And if that's the case, that is, aside from inheriting money from a rich relative, about the best financial deal you can be offered. So for a lot of companies, kind of a garden variety example is that for every dollar you put in, your employer matches it with 50 cents. Right? So what is that? That is a risk-free, guaranteed, immediate 50% return on your money. It's just laying there on the table waiting for you to pick it up. And so if you are not taking full advantage of this, so usually there's a cap on this. Right? Usually, there's a certain level above which, the employer says, okay, we're giving you as much as we're going to give you. If at all possible, if you can contribute enough to your 401k so that you are maxing out that money that's there waiting for you on the table, then that is the first best investment decision that you can make. And so if you haven't filled out that 401k paperwork, do your best to make that happen. If you're not maxing out the employer match, if there's still room where you can increase your contributions, do whatever you can to try and make that happen. Because again, that money's waiting there on the table for you to take. Once you make that decision, then your investment portfolio should be primarily made up of equities. Equities is just another term for stocks, investing in the stock market. And the reason for this is that if you're investing for the long term, and that's a key point to keep in mind here, is that if we're talking about our retirement savings or any other sort of long-term savings, the stock market has the long-run highest average return. So if we look at U.S. stock markets over the last 100 years, the average annual rate of return is between 9 and 10% per year. For bonds, it's about between 3 and 6%, depending upon what type of bonds you're looking at. And then for cash type of investments, namely, stuff we put in our checking account and our savings account right now, the long run average is about 2%. And we know right now, if you're putting money in your checking and savings account, you're earning pretty close to zero right about now. We're just in a very, very low interest rate environment. So if you are building for the long term, well, the stock market is where you need to be. Now, should you put 100% of your money in there? Probably not. You want to diversify not just across the stock market, but across other asset markets. And so that's a personal decision. So some of us are just, very much uncomfortable taking on a huge amount of risk in the stock market. Okay, well then maybe you put 40% of your money in there or 50%. Those of you who are young and in your 20s or in your early 30s and you're just starting out investing, you should feel pretty comfortable putting 70% or more of your money in the stock market. That level that you're able to invest or willing to invest in the stock market obviously is going to affect the riskiness of your portfolio, but it also affects that long-term return. And the longer time frame that we have to invest, the more that we can weather the ups and downs of the market. Now, to go to the other end of this argument, if it's short-term money, if you have cash in your account right now that you're going to need next year, let's say for a down payment on a house, or you want to buy a car, or you want to pay off your student loans. Well, you definitely do not want to put that money into stocks because within a year, stocks, a few years ago, we saw stock markets go down 40% in 1 year. If that's money I need in the short term, I need to keep it safe. I need to keep it in a checking account, a savings account, a money market account, and yeah, that means I'm not going to earn much on it, but I know it's going to be there when I need it. So we only want to take on risk when we have longer amounts of time to be able to weather both the ups and the downs of the market. So if you're thinking short term, think safe. If you're thinking long term, think riskier assets like stocks. So along with bonds, along with stocks, we can also diversify into bonds and real estate investments. So if you're somebody who's uncomfortable putting, let's say, more than 40% of your money in the stock market, well then most of that remaining 60% probably should go into the bond market, which is a lower risk and also lower return investment. But if it brings that risk down to a level that you're more comfortable with, doesn't keep you up at night, well then that's the right fit for you, right? You accept that it's probably going to be a lower level of return, but it's also going to come commensurately with a lower amount of risk. Now, real estate investments, for most of us, our biggest real estate investment is the home that we own. Right? So any of you are homeowners out there or expect to become in the future, you may say, yes, you may hear that you need to diversify more into real estate investment. Well, if you own a piece of property, you're already doing that. In fact, for many U.S. households, their most valuable asset is the home that they own. So they don't need any more real estate investment. If anything, they need to invest more in stocks and bonds to balance out this big real estate investment that they have. So to summarize this slide, if you're younger, you should feel comfortable investing more in equities because you have a longer time horizon. So, you can invest money today and the market goes in the tank tomorrow. It doesn't matter. You're still 30 years from retirement. It's going to come back. And so the younger you are, the more you put into equities. If you're somebody who's in your 40s, 50s, maybe getting closer to retirement, typically what we see people do is they get within, let's say, 10 or certainly within the last 5 years before they expect to retire, they start to take some of that risk off the table. So if they had been invested, let's say 70% in stocks, maybe they sort of dial that down a little bit, dial up the investment in bonds a little bit. The idea being that, okay, you've built up this nest egg, and so as you get close to retirement, you want to protect that. You don't want to see it take a big drop right before you retire. That happened to a lot of people right before the financial crisis in the last big recession, and people had risky portfolios. And they were expecting to retire in a year or two. When the market took that big drop as it did in 2007, 2008, well, these people had to do one of two things. They either had to say, okay, well, I guess I'm not retiring. I guess I'm going to keep working for a few more years. Or if they did retire, well, they were retiring probably at a lower standard of living than they were hoping to get. So that's typically what we see, is that as we get closer to retirement, we also start to dial back the risk on our portfolios. Again, because our investment time horizon is starting to get shorter, at least, shorter until our retirement date. Finally, the last point on the slide, we want to rebalance our portfolios each year. And by that, I mean, each year, if I started the year saying I want to have 70% of my money in stocks and 30% in bonds, let's say, well, over the course of the year, those two categories are going to move in different amounts. Maybe the stock market had a really good year, and so at the end of the year, you're no longer 70-30, you're closer to being 80-20. Well, if you don't want to take on that much risk, then what that means is that you should sell some of the stocks that you own and put that money back into bonds to bring those weights back to 70-30. Now, I say owning stocks, putting money in the stock market, and you say, oh gosh, do I have to research all these stocks, learn about all these different companies? Turns out, no, not at all. We can invest very easily and very quickly in the stock markets by owning a very commonly held investment called a mutual fund. And a lot of you, in fact, probably the majority of you in this room already own them. If you don't own them and you're not familiar with them, or if you do own them and you're not terribly familiar with what they are, what it is basically, the reason why it's called mutual is that it pools together the money of a bunch of different people. And it puts it together in one fund managed by a manager, or maybe a team of managers. But what it does is that it gives us what we call economies of scale. If I want to have a diversified portfolio and I want to do it all by myself, I might have to buy several hundred individual stocks. Well, that's really tedious to do. On the other hand, if I commingle my money with all of your money and we sort of pool it together in sort of one big pot, well then we can hire a manager who will then go out and buy all those 400 stocks for us. And so what that means is then each of us has a pro rata share of that big pool. So it allows us to get a very diversified portfolio at a very, very low cost. And so that's the big reason why mutual funds are the go-to investment for so many investors, is that it's a way to get a diversified investment with one financial decision, basically one click of your mouse. I want this fund, I want to put this money into this fund, and the moment it lands in that fund, it's already a diversified portfolio. Now, it takes a little bit of effort to make sure we're choosing the right funds, but I can talk about how that actually is much simpler than a lot of people make it out to be. So if I'm investing in these mutual funds, well, what do I pick? Turns out there are thousands of them out there. Now, in your 401k, some of that decision is made for you because there's a list of choices that you have. And maybe here at the medical center or in the hospital complex, there's a financial advisor who can maybe give you a little bit more information about some of these funds. But generally, what do we want to look for? What we want to look for are funds that are broadly diversified. By that I mean they try and cover the landscape of U.S. and world stock markets. And I think you want to own both. You don't want to have all of your money in U.S. stock markets. You want to invest in international markets as well, because there are some years where the U.S. markets are down, but global markets are up. Again, that helps the diversification of your portfolio. But one of the true tests of a quality mutual fund is actually very easy to identify, and that is the expenses that they charge you. The best performing mutual funds out there actually tend to be the ones that charge you the least. Because if they're charging you the least, that means at the end of the year, the most money is left to work for you. And so the class of investments that by and large have the lowest expense ratio are a class of mutual funds that we call index funds. So you've probably heard this phrase. All it means is that it is a mutual fund that seeks to track the performance of some stock market index. And there's also bond market index funds as well. I don't mean to exclude those. But if I buy a fund that seeks to track the Standard & Poor's 500, which is just simply a broad market index that gives us a barometer of how U.S. stock markets are doing, then what that fund is trying to do is just trying to mimic that index's performance. Not actively trading to try and beat it. It's just simply trying to be average. Now, you may ask yourself, well, I'm not average. Right? Why would I accept average? It turns out to get above average, it's really hard. Remember that every trade in our financial markets is a zero-sum game. There's a winner and there's a loser. And whether it's us trying to be those winners or whether it's us trying to pick financial managers who we think are going to be the winners, it's very, very tough to do. There are millions of people around the world who do nothing more than stare at their trading screens 10, 12, 15 hours a day, looking for even the barest hint of an advantage in their trading. Does that mean that we're going to be able to beat them doing it a couple of hours a month? Probably not. I'll be the first to say that I am not confident that I can do that. And I do know a fair amount about this stuff. But it's not my day job. Right? I teach. I do research. I serve on a whole host of committees that have too many meetings. And so, yeah, I'm not staring at my trading screen all hours of the day. So am I going to beat this person whose sole job is to work on the trading floor for Morgan Stanley? No, that person's probably going to beat me. But the thing is, I don't need to beat that person. If I earn the average return and at the same time minimize my expenses as much as I can, I'm putting myself in very, very good position to generate significant wealth in my portfolio. Right? So that's the great news, is that we don't have to think about this all the time. We don't have to study this all the time. As long as we control our expenses and diversify our portfolios and rebalance every once in a while, we can just let it go to work. Whew. Don't have to stare at don't even have to look at our Mint account all that often. In fact, I think the more often you look at it, I think that sometimes can lead you actually to make bad decisions. So I think once you set it up and you say, okay, I'm saving money on expenses, I'm diversified, let it go to work. Doesn't mean it's going to go up all the time. We have good markets, we have bad markets, and we have to learn to weather them. But if we set up our portfolios following those relatively basic rules of thumb, then we're putting together something that is a powerful wealth generator. Okay, so to talk about these different asset classes, this is a graph I pulled from actually a textbook, and the data is actually a few years old here. This only goes through 2012, but really this I'm really just pulling it for just the picture that it paints for us here. Even though we're missing a few years of data, it doesn't change the story at all. This is the performance of a variety of different asset classes. So this red line here at the top is investment in small stocks. Small stocks are small companies, startup companies, young public companies. The next line is the Standard & Poor's 500, which is the 500 largest companies in the U.S. market. The next line down is a world portfolio, so a broadly diversified portfolio of stocks that are outside the U.S. Then we have bonds that are issued by U.S. corporations, and then Treasury bills, which are short-term bonds issued by the U.S. Treasury. If we were to have invested $100 in each of these categories in 1925, and raise your hand if you did so, we can see how well those investments performed over these last, 87 years that we have in this data sample. All right? So if I had invested $100, let's say in corporate bonds, very solid investment, right? Very important part of our portfolio. That $100 would have turned into $21,387. That would have been an annual average return of 6.36%. All right? Well, see, if I take 6.36% and I double it, I get 12.72. Well, 12.67 is roughly about twice as much as this. Right? But notice the difference in those dollar amounts. That same $100 that turned into $21,000 in bonds would have turned into $3.2 million in small company stocks. This is the power of compounding, the power of geometric progression, for those of you that remember that in math. Basically, what this is telling us is that, that compounding power, earning that interest on interest, that is the major long-term wealth generator in our portfolios. And so just going from a rate of return of 12.6 down to roughly half of that, look at how much that would have changed your ending value. Your ending value would have been a tiny, tiny fraction of what it could have been had you just invested in something 6% lower. Now, this is not an advertisement for you all to run out and invest in nothing but small company stocks. Far from it. My point in sort of pointing this out here is that when we're investing, this actually gets back to my point about controlling expenses. The less you pay in expenses in your investments, the more that is left to compound. And so on my next slide here, or one of my next slides here, I'll show you the difference. Like if you're paying just 1% more per year than you should, how much that's going to cut your earning power. So the moral of the story of this slide is, well, first of all, invest for 87 years if you can, but if not that, we want to be cognizant of what our expected rates of return are. Well, certainly they're more in stock type of investments, less in bond type of investments, and certainly as we get to things like Treasury bills, this green line here, well, those are very, very safe, but they're going to generate very, very low return. They're good for short-term money that we know we need, in a relatively short period of time. But for the long run, if we're talking about 10 years or more, then the data shows that 10 years or longer, stocks are generally your better bet. Lauren, how am I doing on time? We're good? Oh, nah, actually I'm not. I'm taking too long here. Let me pick up the pace here. I've got, all right, yeah. I didn't even see the clock. See, I get going, typical professor, right? Ramble. So this next slide is a measure of the risk of these different types of investments. And we can quantify this risk by saying, okay, if I look at the annual returns of investments, right? If they're low risk, I should expect them all to sort of be packed into kind of one area, right? What I see is what I expect to get. On the other hand, if the returns in a particular year, and by return, if I've been unclear about that, it's the percentage that I earn or lose in a given year. If that's spread out all over the map, that's an indication of a very risky investment. So Treasury bills, pretty much everything lines up in a very small area. Basically, if I invest in Treasuries, I know exactly what I'm going to get when I'm going to get it. But at the other end of the spectrum is small company stocks. This is the distribution over those 87 years of rates of return of small company stocks. We had some years where an index of small stocks more than doubled in value in 1 year. We also had years where they went down by more than 50% in 1 year. So, yeah, small company stocks have the highest average return, but they also have the most risk. And so again, what we need to do is balance the risk and return that we feel comfortable doing. So whether that's a 50-50 mix of equity and debt, whether that is a 80-20 mix if you're younger and you're more risk tolerant, or even just investing maybe 25, 30, 40% in stocks if you're getting closer to retirement and or somewhat risk averse. We want to make sure that we have that mix that matches our level of risk tolerance so that we can earn the rate of return over time that we're comfortable taking on the risk to do so. Okay, I also mentioned expenses here. Let's say we invested $1 at 9% for 40 years. Okay, that $1 would turn into $31.41. Let's say I put that dollar into a mutual fund that charged me an extra 1% in expenses. Right? 1% doesn't sound like much, but compounded over time, it really cuts into our earning power. Basically, we would have earned 50% more had we invested in the fund that took out less expenses and allowed us to earn a full 9%, rather than a fund that charged us that extra 1%, which meant our net return was only 8%. That 1% difference looks small, and sure, in 1 year it's going to be small, but compounded over your lifetime, it becomes huge. So if there's anything that I think affects your investment return the most, it's not do I pick fund A or fund B, though that certainly will make a difference. The one decision that's most under our control that will affect our wealth generating power is the expenses that we're charged. And the good news is using things like index funds, or you may have heard the phrase exchange traded funds, which try to mimic an index. It's just a slightly different mechanism. Those types of investments can give us diversified portfolios with expense ratios per year less than 0.25%. In fact, a lot of them are less than 0.1% now. So you can get a broadly diversified portfolio. It's easy to access with a minimal amount of expenses. So look for index funds, look for ETFs. They tend to be the cheapest, and there are so many of them now, literally thousands, that there's a whole list of them that will fit each of your investing needs. Okay, as we start to wrap up here. So Jack Bogle, founder of the Vanguard family of mutual funds, he says, never think you know more than the market. Nobody does. And now, granted, that helped him build a business because his business is in index funds, which go by the mantra of, yes, you cannot predict the market. But it turns out the data is actually very strongly on his side. Trying to guess the market, time the market, predict the market, very, very, very tough thing to do. So if you're looking at investments, don't have your eye drawn to the one that did the best this last year or the best this last 3 years. One of the things that makes markets hard to predict is that there's very little persistence in performance. Yes, there is a Warren Buffett out there who's done it for 40 years, 50 years. Yes, there is a George Soros who did it for nearly that long. Julian Robertson, a few other names out there. But for us investing and choosing mutual fund managers, whoever was good last year, frankly, is still a coin flip as to whether or not they're going to be good this year. And whoever was bad last year is a coin flip, basically, as to whether or not they're going to be good this year. Very, very hard to predict. There's no persistence in performance. In other words, one manager can't say, hey, I was good last year, that means I'm going to be good this year. Our evidence is very much strongly against that. Again, it's a very competitive market, right? Whatever somebody was doing right last year gets mimicked or gets imitated or whatever, and it doesn't work this year. It's very, very difficult to beat the market. And so trying to time the market, all the effort that you put into this is by and large going to be a wash. You'll spend more money on expenses, right? Because every time you make a trade, it costs you money. Your broker will charge you for it. But all that effort, on average, is probably not going to amount to much. Now, it's very easy to be puzzled or to be tricked into thinking otherwise because people talk about their investments, but what do? They only talk about their winners, right? You know, if I made an investment that was a terrible choice, I'm not going to brag about that to my friends. But yeah, that stock I bought at 20 that went to 70, oh, I'm telling all my buddies about it, right? You know. So it's very easy to think in our minds, well, you know, if that idiot can do it, well, then I can do it. Well, you're probably not getting the full picture to begin with. And I would say doing all of these things, you know, spending too much time doing excessive trading, you know, having more confidence than you should have. And again, this applies to me. I'll be the first person to say that, you know, yeah, I know a lot about this stuff, but I'm not out there on the trading floor every day. I'm not at my trading screen 12 hours a day. I'm not going to beat the market. Right? And I think that's just the simple truth. It's not my primary focus. And so what I would say, one of the great things about this is that if you can simplify and follow these relatively simple rules, you You can put together that portfolio. It will work for you for the long term. You don't have to spend a lot of time thinking about it. And that extra time that you might have been spending reading Money and Smart Money Magazine and all these other books that were out there, well, you could spend that time on your career or your personal life. And those are bound to be investments that have a far higher rate of return than you trying to guess whether Cisco is going to outperform Intel next year or whether Fund A is going to outperform Fund B next year. Okay. All right. Thank you.
You're
Thank
welcome.
you,
Dr. Wellman. So a couple of quick announcements before we take questions. I have the microphone, clearly, and I'm trying to find the other one. But Tony and I are going to be going around with the microphone so that we can record the questions that are that you direct towards Dr. Wellman. So please speak into the microphone and wait for us to get around. Also, you have evaluations on your chairs. Please fill out the evaluation before you leave. It just takes like 2 minutes. We try to make them as simple as we can. So we really appreciate the feedback, and we are going to use it for future programming. All right. Questions?
I actually have 2 questions.
All right.
So I heard on the radio the other day a gentleman said your best way to invest in stocks is to invest in something you use every day. So, for instance, Netflix is what he was using as an example. Mm-hmm. What is your take on that?
A gentleman named Peter Lynch, who for a long time was a leading mutual fund manager, that was his strategy, was that he invested in things that he knew and could understand. And that's somewhat Warren Buffett's investment strategy as well. Warren Buffett doesn't invest in technology companies, but he invests in companies like Coca-Cola because he drinks a lot of it and he like really understands the product. However, that would only apply to investing in individual stocks. And so if you're just starting out and putting together a portfolio, I would say actually shy away from individual stocks and instead put most of your money in mutual funds where you're going to be broadly diversified. So if you've already done that, if you already have a pretty well-diversified portfolio in funds and you're thinking of augmenting it with some investment in individual stocks, then yeah, that's not a bad way to think about it. It doesn't guarantee that you're going to earn a return higher than the average. You don't want this to tip into, okay, I watch a lot of Netflix, so that means I'm going to know where Netflix's stock price is going. Again, that's a tough thing to predict. But if the more familiar you are with an investment, the more comfortable you're probably going to be having it in your portfolio because you will have learned about the product, learned how the company works, and decide, okay, does this fit in my portfolio? So once you've invested in funds and built up a broadly diversified portfolio, then if you want to augment it with individual stocks, then that's one rubric you can use to start thinking about them.
Okay. And one last question. Mm-hmm. What is your take on annuities as far as savings?
So annuities are primarily a product sold by insurance companies, though a lot of financial firms sell them. And for particularly people that are at retirement or getting close to retirement, they can be a very nice mechanism to offload risk. And so I mention them as an insurance product because that's partly what they are. And so how an annuity functions, if you're unfamiliar, is that you take, let's say you take part of your nest egg at retirement and you invest it in an annuity. So you give them the money and in exchange you receive a fixed payment every month. So one of the concerns about people when they retire is that, okay, I've built up this nest egg, well now, how much can I take out of it each year? And I'm afraid I'm going to take out too much and I'm going to deplete it too fast. Well, investing in an annuity sort of offloads that risk. So you give them X amount of dollars and they give you Y dollars every month. And so that makes it easier for you to plan your monthly finances. You know it's coming in, it's going to be reliable. And that can be structured to last, for as long as your life, or can be, if you're married or, or have a partner in the contract, it can be until the second partner passes away. And so what that does is that it, allows you to plan your finances more easily. So there's a cost to doing it, but the benefit is you get to offload that risk and worrying about how much do I take out or how much do I not take out. So I think it's a very good strategy, at least with part of people's retirement money, just to sort of help secure, a steady cash flow month by month. And I'm happy to go past 1 o'clock here. It's, it's 12 to 1, but if people have questions, I'll stay as long as you have them.
This should be pretty quick. Is there like usually a minimum amount if you're interested in investing in a mutual fund that people normally put towards that, or how much do people usually initially invest in?
There are minimums with a lot of fund companies, but there are a lot of choices out there where that minimum is, $100 or less, honestly. So there's a class of mutual funds that have really grown in the last 10 years called exchange-traded funds. And really all that term is, it's a mutual fund investment, but it trades like a stock. So you can buy and sell shares of it, throughout the trading day, just like you could with a stock, except it's a mutual fund. And so there, you could buy one share of an exchange-traded fund. So you can start out with a very, very minimal investment. And of course, that it can go as high as, as money you have to put into it. But that's been one of the great things about the growth of personal investing and the power of the internet to empower people to make that choice, is that it's forced these companies to say, look, these people aren't going to brokers anymore. So as a result, we have to come to them and say, okay, you can invest in our fund and you can do it for as little as, buying one share that costs $10 or for a $100 minimum or $250 minimum, things like that. So it's never been more accessible for even people just starting out with a tiny bit of money to start putting that portfolio together.
My question, is there like a calculation or a number you can look at to say, all right, I'm 20, so I should have X dollars in investments, and now I'm 30, and if everything's gone correct and the economy this, then my investment should have grown here? Mm-hmm. Or is there a way to, I guess, like compare yourself? Like, because you hear about some people at this stage, and I guess I want to compare a group.
Yeah, absolutely there are. So there's dozens, probably thousands, frankly, I don't even know why I chose the word dozens, but of what we call retirement calculators. And so those things are, they're trying to predict the future, which is always difficult to do. But let's say you're 35 and you say, okay, where am I going to be at 65? I have this much saved. I'm earning this level of income today. I'm putting this amount of it, this percentage of it in my 401k. If I earn this percentage rate of return per year, how much will I have grown that to at age 65? So there's a lot of free calculators out there to do that. You have to put in a lot of assumptions. One, you have to sort of make an assumption on what rate of return my investments are going to earn, which, given the investment classes that you're choosing, you probably can get a pretty decent ballpark estimate of that. But another thing you also have to put in there is how much inflation is going to be. If so, basically, 30 years from now, how much is $100 going to buy? I mean, none of us really know. So these retirement calculators try to structure it in terms of today's dollars. Like, we'll back out the effects of inflation and say, okay, at age 65, you would have the same purchasing power as X amount of dollars today. But to do that, we have to assume an inflation rate. Maybe we could just look at sort of the long run average, which is right around 3%, I would say. So yeah, you can definitely do those things. They're good as kind of a guidepost along the way, because a lot of them will say, okay, well, if this is your goal at the end, you are X% above it or X% below it right now. And so that can be, help to be a good disciplining technique to sort of say, okay, I need to save more, or I'm doing okay for now. And you can sort of recheck them, year by year, every few years, to get a sense of, yeah, am I achieving my goals, getting closer to my goals? So yeah, there's a bunch of those out there, and they're all pretty good. If you go to the major investment company websites, if you go to Vanguard or T. Rowe Price or Schwab or Merrill Lynch, or Ameriprise, they're all going to have a calculator like that, and it'll give you a kind of a nice, rich picture of what you're looking at. Yes.
Yeah. Well, thank you very much again for coming. One question, the question I had for you was, so like you said, even when you decide to invest in a mutual fund, there's thousands of mutual funds out there. Do you have any general principles of kind of which one to select? If you're just an investor, you have a large time horizon and many years to go, because there's even specific like sector mutual funds, right? So if you invest in if you put all your money in the energy mutual fund and think I've done the right thing, and then it's dropping and dropping and dropping. So how do you kind of decide if you want to just be safe and make a good investment in terms of which of the thousands of mutual funds?
Yeah, so I'll start at this sort of the end of what you were saying and work my way back, is that there are a lot of what are called sector funds that invest in a particular industry or a particular sector, and I would say you generally want to steer clear of those because, or at least they should be only a tiny fraction of your portfolio, because you're not going to have a diversified portfolio, right? If you put all your money into an energy sector fund, and not saying that you're doing that, but you know, just to take the extreme example, well then yeah, that's going to be a very undiversified portfolio. And so as a result, that will have more risk than, you know, I think most investors would prefer to have. So, you know, I would say, first of all, the easiest way to do this, and I think generally a very solid way of doing this, is to look for index funds. Basically look for funds that are trying to mimic a broadly diversified stock index. And so then from there, you know, you can tailor it to, is this a US index fund? Is this an international index fund? Is it a stock index fund? Is it a bond index fund? But once you start with index funds, you're immediately starting with a portfolio that's going to be well diversified, broadly diversified, and also going to tend towards having very, very low expenses. And so those are two great places to start. And then you can look further and say, okay, is this one even a little bit cheaper in its expenses, or is it a little bit more broadly diversified? But if you start with, you know, start with those two factors, you're already in the right ballpark.
So I also am interested in annuities.
Mm-hmm.
I'm a woman of mature age, and the financial institutions that I deal with are now trying to talk to me about purchasing annuities. My impression was that there's a good size commission that they take for themselves before they invest in your annuity. And also, I have the fear that if I purchase an annuity and then 1 or 2 years into receiving the dividends from that annuity, if I pass away, that money's just gone, and my dependents won't inherit anything.
Right. So yeah. So a couple of things there. One is that, yeah, when you're buying these products, just like with investing in a mutual fund, you want to pay close attention to what the expenses are, because they can be pretty steep. And so just as index funds sold by Vanguard and T. Rowe Price and companies that sell index funds, these mutual funds with very low expenses, they quite often are also purveyors of annuities. And so they're going to tend to have annuities that have the lowest level of expenses and commissions built into them. So just as you might look at sort of the usual suspects of places to invest in mutual funds cheaply, they may also be the great choice or a great choice for investing in annuities. So because you want to, you know, every dollar that's an expense, well, that's being taken out of your investment. Exactly. So you can look on those websites. So a lot of annuities are sold by insurance agents and financial planners, but you can also do it independently yourself, just as you can with your portfolio. So it, you know, means, you know, going out and sort of seeking out these annuities, but they're out there, and you can do it at a relatively lower expense. The other part of your question, the annuity contract can be structured in a variety of different ways. So the standard life annuity basically is, just like you said, you get paychecks for as long as you live, whether that's 1 year or 40 years. And so, yeah, there's the risk there that, well, okay, yeah, maybe you don't get what you pay for if, you know, God forbid, you you pass away at a younger age than you would hope. So there's that risk. You can also structure them to where there's an ending payout that may have a residual payout that may sort of trickle down over time. So like, let's say you invest in this contract and the person who invests in the contract passes away after 2 years, well then maybe there's a residual payment that would go to their estate. But if they live for 30 years, well maybe that residual payment has gone away or it's very tiny, because at that point the annuity has kind of served their purpose. So there's a variety of contracts out there. It's hard to predict the future of not just the financial markets, but of our own lives certainly. And so you can sort of think about that as what type of contract you might want. Now the other part of that also is that when most people invest in annuities, they don't put their entire nest egg in it. So and partly for that reason. So maybe you do it with a third of your money or half of your money, some fraction of your money where you say, okay, I want to lock in this steady paycheck that I know is going to be there every month, but then maybe the remainder of my nest egg I kind of manage on my own, and so that way, if there's part of it left, then that can go to my beneficiaries.
Hi, I have 2 quick questions, if you don't
Yes.
mind. So first, there's a ton of different trading platforms out there, like Scott Trade, Ameritrade. I just didn't know if you had any particular that you had experience with that you could recommend. Is the first question.
So they're all pretty close. I mean, if you look, if you just Google best online brokerages, I mean, there are different sites that will rate them. But it's a competitive market, and so the good news about that competition is that it's forcing them all to be pretty good. So whether it's Scottrade or E-Trade or TD Ameritrade or Schwab or any number of others out there, they all do a pretty good job of providing, one, a large list of investments, and research platforms if you want to research stocks and mutual funds and other investments. And at the same time have very, very low commissions. And the standard is kind of somewhere around maybe $7 or $8 a trade. Some of them do it by share, so maybe they charge you a penny a share or something like that. But all of those, they're really, really low. So if we go back 40 years, the minimum commission was $50. And that was back in 1975 when a dollar bought a lot more. Well, now it's, you get so many of these websites that'll charge you $7, $8, maybe $10. And so that's the good news. And so really, it's hard to go wrong. As long as you're using one of the major names, I think you're going to have something that has the online resources that you need, also at a very, very low price.
The second question, I'm learning that the word investment is pretty broad, and I've heard people often refer to things like life insurance as investments, and I don't necessarily know that I understand that.
Yeah, so life insurance can be structured as an investment. So basically, if you've heard of whole life or variable life or universal life, what those are is it's an insurance contract that starts out with basic what we call term insurance, which is just death insurance effectively. But then it has an investment component grafted onto it. And so this is a way for insurance agents to sort of, sell products that have an investment component to it to their clients, because people that have an insurance license don't have a securities license. A securities license is much more difficult to get. But if you have, let's say, a life insurance license, then you can sell these products that have this investment component sort of tied into them. Generally speaking, I don't keep close ties on this, so maybe competition in the market has made this a better deal. But most people would say you're better off buying insurance for the insurance and putting money into your investments for the investments, rather than buying this kind of hybrid type of contract that may be neither here nor there, effectively. So yeah, now I'm sure there's exceptions to that. I mean, I don't want to disparage the entire insurance industry, with just one statement. But by and large, I would say that's true. If you're buying life insurance, buy life insurance, term insurance, by that I mean. And then take the remainder of that money that you might have spent on that other hybrid type of contract and instead put that into a mutual fund on your own. Mm-hmm.